At Economic Research, Lloyds Bank. He's joining us on the phone line from London. Thanks so much, Trevor, for taking out the time for this call today. So the reaction is very interesting. We're seeing the tumble in the British currency, whereas equity markets are rejoicing the fact that there's more easy money coming in thanks to the Bank of England now. Do you expect these two trends to remain intact for the next couple of days?
Yes, I do. But before I answer that, remember, my title is, I'm no longer at Lloyds Bank. I am professor at Derby University and a member of the IEA, Institute for Economic Affairs in London, Shadow Monetary Policy Committee. So
apologies for that. Yes, we've okay. Noted that.
I'm commenting based on that role of mine. But you're absolutely right. One would expect the two trends to continue, which is to say the Bank of England has cited significant weakening in the economy as a result of Brexit. The action that it's taken is included in the growth forecast for next year, which means that the 0.8% growth that they now have in, rather than the 2.25% or so that they had previously, includes the easing which they have announced, which is why they hinted that there may be further action necessary to ameliorate the slowdown that they think is going to take place in the UK economy. And that is one of the reasons why the pound fell, because the cut was as expected, but the further action announced, such as the quantitative easing of 70 billion, was not as expected, and therefore the pound was weakened as a result. And that's also partly why, on the expectation that exporters benefit from a weaker currency and from lower funding costs, that the equity market seems to have benefited somewhat.
Sure. Trevor, so what's the sense for equity markets from here on? Because after that low that we saw on the Brexit day, they've moved up very, very smartly, pretty much ignoring whatever concern, saying it's probably in the long term. But looking at the BOE commentary on growth, it is fairly concerning, perhaps one would say. Do you expect that concern to come back to equity markets anytime soon?
Well, I think we need to consider this, which is that equity market performance, yes, is partly based on growth expectations, but it's also based on relative returns on different investment classes. And I think that we mustn't automatically assume that the rise in the equity market is based on the prospect of higher long-term growth as a result of the easing of policy. It could be just reflecting the fact that the return on equities compared with fixed income have increased. In other words, because of the fall in long-term interest rates, because of the depressing effects on yields of government buying of both corporate bonds and government bonds, that it's relatively more attractive to invest in equities. And some of that money shift may simply be what we are seeing, and therefore causing the level of equities to be rather higher than otherwise.
All right, Trevor Williams, appreciate you joining